Guys, these are 3 stocks that are at or near a 52-week low. It's important you watch this video in full because there are major learning lessons on the emotion of investing in all 3 of these stocks. The first stock is CVS. So let's pull up CVS. Guys, CVS is an incredible company. You know why? They own 25% of the prescription market share versus Walgreens at like 14% at number 2. That's a huge share. Now, are there concerns with CVS? A little bit. So the all-time high on CVS is back in 2015, July of 2015, at $113 per share. That's a big difference than where they stand today. Now, here's my first concern about CVS. We have about a $70 billion market cap. So if you buy all the shares outstanding, you're going to spend about $70 billion. But if you go right down here to their enterprise value, that difference, 70 to 230, is their debt. Now, CVS has a lot of leases. That's part of the debt. But it's still a scary thing to see. Do I think leases should be debt? Absolutely. You owe that money. So unless you go through bankruptcy, you're going to owe that money. But is it really the same thing? I get it. It's an operational cost as well. So it's kind of like I get the argument both ways, but it is owed money. Now, you come over here, a very attractive thing for CVS is, look at that dividend yield, 4.6%. And the great news is, guys, it only eats up $3 billion of their 5-year average of $13 billion in free cash flow and last year's $8 billion. So even though last year's free cash flow was significantly lower than its 5-year average, they can still easily afford that dividend. Now, you guys know where I stand on dividends. I look at dividends as the last thing a company should pay. And when they pay it, I believe in a special dividend. Don't get excited about having this repeating dividend. I believe it should be one time as the finances of the business permit. Now, a couple other exciting things about CVS. Last year's free cash flow, $8 billion, was higher than last year's net income of $7 billion. And the last 5-year average free cash flow of $13 billion, significantly higher than its 5-year average net income of $6.8 billion. So immediately I'm going to sit there and go, let me go to the cash flow statement and see where was there a big, well, it looks pretty consistent here, guys. Look at their free cash flow here. 6.8, 10.4, 13.4, 15.75, 13.45, and $10.4 billion. That's pretty interesting here, if you ask me. All right, so I look at that going, okay, their net income. Now, guys, CVS is basically a grocery store. If you look at the numbers here, they mimic a grocery store. Look at this profit margin. 5-year average, 2.24%. 1 year, 2%. So very low multiples, which makes it very attractive. You know, I look at this thinking to myself, the only thing I don't like about this return on invested capital, 6.5%. That means they don't really do a good job of getting a return on the money that's invested in the business. So to me, you got to pay a cheap price for this company. You've got to get such a low price that you're okay getting that dividend, and hopefully they're buying back shares, which I don't know if they are or not, but let me check on that real quick. Now, here are their stock buybacks going back to 2016 per quarter. So they are buying some shares back here. Okay, and guys, guess what? A company that's buying back shares at 8 times free cash flow, that's good value add for the investors. Decrease that share count, drive at that EPS, that'll drive the share price higher. That's what's so important here. So let's take a quick look here at the 8 pillars. Probably not as bad as I thought it was going to be. Because look, you have a 5-year PE of 10, a 5-year price of free cash flow of 5, cash flow down $3.6 billion while net income is up. Okay, but remember their cash flow is a lot higher than their net income, which I like. The debt level doesn't bother me at all. This return on invested capital, I just look at it going, just get the money back to investors by repurchasing shares, please. Cancel that stupid. Look at this, guys. This dividend's $3 billion a year. If they just spent that $3 billion buying back these shares and the stock price stayed the same, this would be such a value add for their investors. So guys, this is a simple sheet I created. I put CVS's numbers in here. So let's start from the top left. I put a $70 billion market cap in here. They have $1.3 billion shares outstanding, and free cash flow, I call it $10 billion a year. And let's say it grows at 4% per year. Now, I put a stable free cash flow multiple of 15, just a historical average. I'm not putting any premium to it, etc. And the current price is around $54. The current free cash flow multiple is about 7 if you factor in 10 billion in free cash flow. And let's say it's going to go from 7 to 15 as a multiple over the next 15 years. Here's how the amazing thing is for repurchasing shares. This is what happens. The market cap will increase by about 9.2%. But if they just keep repurchasing shares, those shares become $1,000 and appreciate at 23.2% per year. By taking all their free cash flow and buying back their shares and watching their share price increase. That's the power of repurchasing shares at a good multiple. Now, of course, this assumes they use every dollar of free cash flow to buy back the shares. And it assumes every year the free cash flow multiple relative to price goes up and up and up, getting closer to 15. That's the power of repurchasing shares. Here's the interesting part about CVS. Here is their chart. It has gone nowhere in the last, 8 to 10 years. In fact, in the last 10 years, their stock is down 26%, right? So buying a stock sometimes, I see a lot of people on Twitter, and they'll say, this stock has done nothing for the last 5 years. It's a dud. Well, I get how it's done nothing for the last 5 years, but if you cared about history, well, then at this point, you'd have said, oh, look at this company. This thing has skyrocketed since 2009. I should buy it. But then it went down from there. Why? Stocks in the short run are a voting machine. In the long run, they're a weighing machine. And the voting here was, we love CVS. The voting here has been, not so much. Now, I look at this metric. I look at this valuation. I say, maybe the market shifted on these companies for some reason. I think it's important to understand why that is. Maybe it's something where it's the market seeing something that you may not see or I may not see. But that's what makes investing hard, right? Because the fundamentals here look pretty interesting apart from that return on invested capital. All that stuff looks really interesting to me. So you've got to sit there and say, are you attached to this? Or are you attached to the fact that sometimes companies go sideways for a while until the markets can realize the value there? Because CVS is a healthcare business. They're trying to expand into healthcare, do more things so you can go there. I would love for that fact that if every CVS had a nurse practitioner or some sort of telehealth where I could go there and get a response from a doctor immediately or a nurse practitioner. That would be awesome to me. That would be an incredible way. But we don't know what the future holds. And that's part of the emotion of investing that's so difficult. All we can do is sit there and apply the fundamental beliefs that we've learned and that we understand and hope that when the emotion comes, when we see nothing for a while or downward, that we can sit there and say, okay, is this the market overreacting or is this reality? Because we're all going to sit at home and worry about this stuff. Worrying is a fact of thinking is worrying. And that's what makes investing so difficult, is that emotional aspect of it. 10% is fundamentals, 90% is emotion. But it's about merging those two together. And when the emotion starts to take over in the negative sense, even in the euphoric sense, fundamentally, okay, what's going on here? Is this thing a really better or worse thing than I originally thought? And that's exactly why I created the software in the community. I wanted the tools to be able to make fundamental great decisions, but the community to be able to help me with my emotional side. There's thousands of people in here talking every day, cheering on when stocks go down. Trust me when I say it's emotional. My stepson, with Starbucks going down, and we're going to go over Starbucks next. Starbucks went down yesterday, 15, 17%. I immediately got a text. Man, Starbucks is down. This is great. Should I buy some? Like, this is a kid who does nothing with investing, but he's understood the emotional side by being around me for the last 10 years and understanding this. And that's what I want for you. I want for you to be able to cheer on the bad times in the market. That would be a great place for you, because if you're able to do that, you're going to make better decisions long-term. You're going to make more money. So if you're interested in that, guys, click the link below, $7 for 7 days. We have limited spots now, okay? So the sooner you get in there, the sooner you sign up, you're in. If there's a wait list, don't worry. Get on the wait list. You'll get an email on how to fast track yourself onto the software, but go there, sign up so you don't have to be on the wait list. Company number 2, Starbucks. Starbucks yesterday, guys, it plummeted 17%. How's it doing today? Down another 1%. Now, for me, the way I look at Starbucks, here's the lesson learned on this one. Like I said, all 3 of these companies we're going over today have great lessons. Starbucks, oh, look at that. The chart even works there. Starbucks, I think, is a great brand. I think it's a great business. It's got 30-some thousand locations. I don't think it's going away. The customer satisfaction at Starbucks is so high. It gets the same favorability today as it got 10, 12 years ago. We all know multiple people who are addicted to Starbucks. I have a good friend of mine who literally says, I cannot talk in the morning until I've had my drugs. The drug he's referring to is Starbucks, not coffee, Starbucks. The coffee market has really surged in the last 30 years, and Starbucks continues to be the number one coffee destination. I look at that saying, there's something to this brand. So is this a short-term fall? I don't know. Do they have issues? Of course they have issues. Same-store sales were down, North America, international, blah, 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 all over. But is that a short-term or is that a long-term issue? That's the question you have to ask yourself. Even if you look at the last 10 years, the stock's only up 108%. That's about 7% per year. But just like CVS, they have a healthy dividend, 3%. Now, the only thing I don't like about Starbucks is their dividend cost them $2.5 billion a year. That's a big chunk of their 5-year average of 2.8. Although last year's free cash flow was about $4 billion. PE of 20, price of free cash flow of 21. All right. I've had some people reach out to me on Twitter. I put a poll out yesterday. Do you think Starbucks is a buy, hold, or sell? More people said hold and sell than a buy. And people made some valid points as to why they want Starbucks cheaper. I understand that. But I look at Starbucks and say, this company deserves a premium based on the brand it is. Based on the fact that people love Starbucks. Based on the fact that you're basically paying $8 billion per gallon of Starbucks coffee. And people still do it. I have multiple friends who have a Starbucks budget line in their budget. Not a food, a separate Starbucks line. That means something to me. Now, does that mean the future is going to be rosy and bright? No, of course not. We don't know what's going to happen. Look at Starbucks here. The stock price is the same as it was. It's actually lower. Last time Starbucks was at $75 a share. Not last time, but the first time it hit that was back in May of 2019. May of 2019. And the stock has gone nowhere since then. You got your dividend, okay? So I'm gonna look here at the analyst estimates for Starbucks. Analysts are still calling for big growth in their EPS. Now remember, they're still analysts. They still have their biases here, but 420 to 804 in the next 4 years, okay? Revenue growth, actually pretty high. I was surprised by this. Almost double digit the entire time. 9.8, 10, 9.6, 12, 8.9. All right, so let's pull up our stock analyzer tool and see what's going on here. Let's pull up good old Starbucks. All right. I did 6, 8, and 10% revenue growth over a 10-year period. I did 10, 11.5, and 13% profit margin. Free cash flow margin, same thing. And I also have to ask, what's the PE or price of free cash flow I'm going to talk about in 10 years? I put 17.5, 20, and 22.5. Now, guys, for all of these assumptions here, you got to remember, this is why the tools are so important for you. Investing in valuation is an imprecise art. That's why I have low, middle, and high. There's all these things that you have to decide for yourself. And one person might sit there and say, Paul, somebody on Twitter yesterday said, Paul, Starbucks is a 15 PE to me. I was like, wow. I was like, I don't agree with that, but okay, great. I look at 15 as the market average, so you should give a premium to top quality businesses. And I do think Starbucks is a top quality business. Look at their ROIC, growing. 41% over the last 10 years, 5% in the last 5 years, 53%. This is a company that has a moat. High ROIC, this is like Apple kind of ROIC. This is a moat business. Okay, so I want to pay a premium for that. What's the premium? Some people might argue this is too low of a PE or price of free cash flow. Okay, to each their own. The whole point is you engage in the conversation and in the community especially, and you sit there and talk about, hey, what is the right valuation in 10 years for this company? So we hit the analyze button. And again, I did a desired return of 9%. So full intrinsic value, no margin of safety. But of course you need margin of safety because that'll help you on the emotional side. That margin of safety will say, if I'm wrong, I have some buffer. But with no margin of safety, I have a low price of 67, high price of 140, and a middle price of 100. Okay. Is this enough margin of safety for you? I don't know. I mean, is 70 enough versus 100? I mean, if you bought today at 73 and my middle assumptions occur, you're going to make a 13% return, including your dividends. Not bad. Not bad at all. Stock number 3, Cisco. Guys, I love talking about Cisco, and here's why I love talking about Cisco. Let me pull up the chart here and show you the all-time chart for Cisco. Guys, Cisco was written about in 1999, 2000, when it hit $500 billion market cap. And people said, is this the first trillion-dollar company? Its all-time high was right here, March 27th of 2000, at $82 a share. It's currently at 46. This is 24 years later. It has never hit this price. Look at this. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Now, you might sit there and say, yeah, but Cisco sucks as a company compared to back then. Yeah, let's go check it out. Cisco last year did, I'm going to write this down here, $57 billion in revenue. And they did profit of $12.6 billion in profit. Okay? Let's see what they did in 1999, the year before their all-time high. 1999, they did $12 billion in revenue, and they did $2 billion in profit. Guys, please hear me out here. They did the same in profit last year that they did in all of 1999 in revenue. If I told you in 1999 when the stock was $82 a share, and I'd said, hey, listen, guys, they're going to do $12 billion in profit in 24 years versus $57 billion in revenue, what would you say the stock price was going to be? Would you have said it was going to be 47? Or would you have said it was going to be 470? Which one would you have guessed? Guess what? Most people would have guessed 470, but this is proof, and this is the great lesson learned in Cisco, that the euphoria and the emotion of the market drove the stock to nosebleed highs that didn't make any sense. In the short run, the stock was a landslide Ronald Reagan 1984 winning 49 out of 50 states election voting machine. And in the long run, it was the weighing machine. Now, has the market shifted on Cisco? Maybe so. But let's go look. Guys, their PE is 14. Their price to free cash flow is 14. What I love is they pay a dividend here of 3.3% that eats up less than half of their free cash flow. So that dividend looks safe. Look at this return on invested capital, 17. Guys, I want this company buying back their shares. I want them to start buying back those shares. This is not a fast-growing company. Let's look at this. In the last 10 years, their revenue growth has been 2% a year. Last 5 years, 2.65. Last 3 years, 1.17. High gross margin of 64%. Profit margin, low 20s. Guys, this to me is the kind of company, but let's see, you know what I want to look at? Here's one thing of concern of mine, their cash flow. So their acquisitions, they have very little growth in their revenue, and that's what I don't like. 7 billion, 2 billion, 3 billion, 3 billion, 3 billion, 3 billion. So maybe they're not a growing business and they're only keeping that revenue growth up because of acquisitions. That's kind of a concern of mine. But that return on invested capital is pretty decent, 17%. I don't know. Let's check out the 8 pillars here. So only one X on the 8 pillars. Their free cash flow is down over the last 5 years. I don't know why, but that's something you can check out. But other than that, it's an 8-pillar thriller. Now, let's go to analyst estimates here. Not a lot of growth in EPS. This is not a grower, guys. 2%, 3%, 5.4, 3.2, 5%. So this is a company you got to get cheap because they're not growing. They're making acquisitions in order to grow. Revenue growth, I'm actually surprised by this. Analysts are expecting, after this year, some low-digit multiple growth. But again, with inflation, their revenue should go higher. So let's pull it up in the stock analyzer tool. Let's look at the history. Let's pull up Cisco. Thong. All right. So a growing ROIC, which is great. Revenue growth, I did 2, 3, and 4%. Even I'm like, maybe. Profit margin, I did 20, 22, and 24. Free cash flow is significantly higher than their profit margin. Okay. Last year it's the same, but over the last 5 and 10 years, they had way more free cash flow than profit margin. So I did 28, 30, and 32. That's probably too high. Let me go a little bit lower here. Let me go with 24, 28, 30. Now PE, I did 13.5, 15.5, and 17.5. Guys, I think I'm going to go lower because this thing is not growing. So you got to get your earnings you got to get your growth from the multiple, from buying it cheap. So I'm going to do 12, 14, and 16. And again, a 9% annualized return, no margin of safety. Now, guys, before I hit the analyze button, you've seen 3 great examples of companies that have issues. 3 great examples of companies that have been great and have been a little bit of rut for either Cisco for 25 years for the stock or Starbucks as of late. That's the emotional part. That's where we have to merge the fundamentals and the emotional. So I really encourage you, sign up, link below for our community. I hit the analyze button. Boom. I have a low price of 35 to 40, high price of 58 to 70, middle price of 45 to 60. I want to buy it. I have it on my watch list at 40. I actually might change it to 45 and then just start selling puts at lower prices. Thank you very much for your time.